Hello, everyone, and welcome to Intrinsic Movers, where we don't just give you the headlines, we give you the entire thesis. I'm Annie.
And I'm Boyd. Today, we are doing a full, sequential deep dive into Instacart's Q3 2025 earnings, and it's a strategic transformation. We're going to walk through it, section by section, in order.
And we're not skipping anything. We're also going to do something different. When we hit a piece of financial jargon, we're going to stop and explain exactly what it means and how you should interpret it as an investor.
Let's get started. The first part of these earnings to analyze is Section A, Business Model and Strategy.
This section asks the four fundamental questions. Let's start with, what does Instacart sell? It's not just delivery.
The company splits it into three categories. 1. Marketplace services. This is the app we all use. In financial terms, this is their B2C, or business-to-consumer side. 2. Enterprise and omnichannel technology. This is their B2B, or business-to-business side. They sell tech to grocers, like AI-powered caper carts and white-label websites. 3. Advertising and data services. This is their high-profit retail media business.
That enterprise piece is key. The earnings mention omnichannel, which is a term investors need to know. It just means all channels, the physical store, the website, and the app. Instacart's strategy is to provide the technology for retailers to compete across all of them.
The earnings then show business segments for fiscal year 2024. Transaction revenue was $2.42 billion, or 71.6% of the total. Advertising and other revenue was $958 million, or 28.4%.
Investors, watch that 28.4% number. Ad revenue is extremely high profit. As that percentage grows, the company's overall profitability should, in theory, accelerate.
The next section is 1.0 Executive Summary and Investment Thesis.
Here's the elevator pitch for investors. The thesis is that Instacart is not a delivery company. It is a diversified, technology-first platform. Its B2C marketplace is just the engine to fuel the two real high-margin businesses, advertising and sticky B2B enterprise tech.
And the numbers back this up. The earnings highlight 7 consecutive quarters of GAAP profitability.
Okay, first big jargon alert. GAAP. What is it, Boyd?
GAAP stands for Generally Accepted Accounting Principles. It's the official, by-the-book, SEC audited set of rules for accounting. When a company says it has GAAP net income, it means it is legally and officially profitable. No tricks.
The summary also mentions adjusted EBITDA. This is a non-GAAP metric.
Right. EBITDA stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. Adjusted means the company adds back other costs too, like stock-based compensation.
Think of it this way. GAAP net income is the Queen of England, the official, formal, audited number. Adjusted EBITDA is the Prime Minister, the one that strips out the noise and shows the raw operational power of the business. You want to see both moving up and to the right.
The summary's most critical data point. The company is sacrificing average order value, or AOV, to increase order frequency.
AOV is just the average dollar amount of your shopping cart. It's actually shrinking. But that's okay, because the number of orders is growing faster. They are training us to use the app for a $20 fill-in order, not just a $150 weekly shop. More orders mean more touch points, which means more chances to sell a high-profit ad.
The thesis ends on the company's financial strength, calling it a cash flow fortress, and noting the new $1.5 billion share repurchase authorization.
A share repurchase, or buyback, is a huge signal. It's management taking its own cash and buying its own stock on the open market. It's the most powerful, non-verbal way for a CEO to tell investors, my stock is cheap. It also reduces the number of shares out there, which mechanically boosts earnings per share, or EPS, for the remaining investors. It is a very, very bullish sign.
Now, let's get to the meat. Section 2.0, Consolidated Financial and Operational Performance. This is the 8-quarter table.
The first metric to check is GTV, or Gross Transaction Value. This isn't revenue. This is the total dollar amount of all the groceries and items sold on the platform before Instacart takes its cut. It's the size of their ecosystem.
GTV hit $9.17 billion in Q3 2025. That's up 10% year over year.
Let's define YOY. It means year over year. Investors must use this. It compares this quarter, Q3 2025, to the same quarter last year, Q3 2024. You do this to remove seasonality. You'd never compare a strong Q4 holiday quarter to a weaker Q1. You always compare Q3 to Q3.
And this table proves the thesis. GTV grew 10% year over year, but orders grew faster at 14% year over year.
And as a direct result, that AOV fell 4%. This is the strategy we just talked about, proven with data. Trading a 4% drop in cart size for a 14% jump in order frequency. That's a trade you make all day.
Now for P&L teardown. P&L stands for Profit and Loss Statement. This is the core report card of revenue and costs. The first thing you see is a terrifying GAAP net loss of $2.0 billion in Q3 2023.
Investors, ignore this number. The earnings report correctly points out this was not an operational failure. It was a one-time $2.6 billion non-cash stock-based compensation (SBC) charge related to their IPO.
When a company goes public, all the pre-IPO stock options for employees vest, and the company has to take a massive one-time paper expense. It's an accounting rule. It's not real cash.
The real story is what happened after that. Instacart has since delivered 7 consecutive quarters of positive GAAP net income, hitting $144 million in Q3 2025.
This section also highlights operating leverage. This is one of the most important concepts for growth investors.
Operating leverage is a beautiful thing. It means your revenues are growing faster than your costs.
The proof. Adjusted R&D, research and development, expense fell from 1.7% of GTV in Q3 2023 to 1.2% in Q3 2025. Adjusted G&A, general and administrative or corporate overhead, fell from 1.1% to 0.8% of GTV.
This means the business scales efficiently. For every new dollar of revenue, a larger and larger portion drops to the bottom line as pure profit. This is how wealth is built.
So how did they get that order growth?
Section 3.1, the affordability imperative. This is the how.
The earnings have a killer data point. Retailers on the platform offering same as in-store pricing grew more than 10 percentage points faster than retailers who mark up their prices.
Instacart used this data as a weapon to convince partners like Lowe's and Best Buy to drop their markups, making the platform cheaper and more attractive.
They also integrated EBTS-NAP payments. This is the electronic food stamp program. This is a huge deal, unlocking a massive and loyal customer base that was previously shut out.
And Section 3.2 shows marketplace expansion. Partnering with Uber Eats for restaurants, adding 1-800-Flowers. This also drives that AOV for frequency trade.
And the catalyst is the Morrisons UK partnership.
This is a landmark deal. Why? Because it's exclusively for Caper Carts, not the delivery app. This confirms their international expansion is a high-margin, B2B, hardware-first play. It's a brilliant, capital-light way to enter a new country.
Now for the profit engine. Instacart ads.
Ad revenue hit $269 million this quarter. But the key concept here is the Federated Retail Media Network.
Federated just means distributed. Instacart isn't just selling ads on its own app. It's building an ad tech empire.
They power ads on retailers' own sites, like Hy-Vee, and even on competing marketplaces, like Uber Eats.
And the monster deal? The partnership with TikTok. Instacart is TikTok's first end-to-end retail media network partner.
This is the holy grail for advertisers. It's called closed-loop attribution. A CPG brand like Pepsi can show an ad on TikTok, see that you actually bought the Pepsi on Instacart, and prove the ad worked. They will pay a fortune for that data.
What connects all three pillars? The AI transformation.
Is this just buzzwords? Not according to this data. It's the strategic connective tissue. It powers the smart shop personalization, the computer vision in the caper carts, and the ad targeting engine.
But the big news is they are productizing their AI. They've launched Instacart AI Solutions.
This is a new SaaS suite. SaaS stands for Software as a Service. Think Microsoft Office 365. It's a high-margin, subscription-based software product.
For investors, SaaS revenue is the best kind of revenue. It's recurring, meaning it's predictable and stable. Kroger and Sprouts are already launch partners. This is a brand new, high-quality revenue stream.
All this new strategy leads to management, governance, and significant corporate developments.
The CEO transition. Fiji Simo stepped down to become chair. The new CEO is Chris Rogers, a 6-year veteran who built the advertising and enterprise businesses.
This is the most bullish personnel signal possible. They put the guy who runs their most important, high-growth B2B divisions in charge of the entire company. It's an acceleration of the B2B first strategy.
New alliances. Grubhub, for fulfillment as a service, and United Airlines, for marketing.
Now for the cash flow fortress.
Financial health, cash flow, and capital allocation. First, the balance sheet. This is a snapshot of what a company owns, assets, and owes, liabilities.
As of the third quarter of 2025, Instacart has $1.69 billion in cash and $4.54 billion in total assets, versus only $889 million in total liabilities.
That is a pristine balance sheet with almost no debt. Financial health, cash flow, and capital allocation. First, the balance sheet. This is a snapshot of what a company owns, assets, and owes, liabilities.
As of the third quarter of 2025, Instacart has $1.69 billion in cash and $4.54 billion in total assets, versus only $889 million in total liabilities.
That is a pristine balance sheet with almost no debt.
Now, cash flow. This is not the same as net income. This is the actual cash moving in and out of the bank.
Net cash from operations for the first 9 months of 2025 was $788 million. This is a 47.6% increase from the same period last year. They are gushing cash.
And what do they do with that cash? Aggressive capital allocation.
This is the $1.5 billion new share repurchase program, plus a $250 million ASR, or accelerated share repurchase.
An ASR is just what it sounds like. It's a tool to execute the buyback immediately. They give $250 million to a bank today and say, "Go buy our stock now." It's a sign of extreme confidence.
Now the outlook and the catch. Outlook, identified risks, and actionable investor insights.
Management's guidance. This is their official forecast for next quarter, Q4. They are guiding for strong GTV of $9.45 to $9.6 billion.
But identified risks. There is a big one.
The EBT-SNAP funding scenarios. Management explicitly said their strong guidance is partially offset by this.
This is a macro or political risk. It's out of their control. If government funding for food stamps is disrupted, it will directly hit their GTV.
But, as the earnings report says, this risk is the best possible argument for their entire diversification strategy. It's why they are expanding into restaurants, B2B, and international to make this risk irrelevant over the long term.
Management lists the KPIs to monitor. KPI stands for Key Performance Indicator.
Management says investors should stop caring about AOV. The new KPIs are order growth, the proxy for frequency; advertising and other revenue growth, the proxy for profitability; new enterprise partner announcements, the proxy for sticky B2B growth.
Okay, that's the end of the Phase 3 annual deep dive part of the earnings. Now for the Phase 2 quarterly analysis engine that zooms just in on Q3. This is great data.
Section A, Quantitative Performance. We've hit this: $939 million revenue, $144 million net income.
Section C, Profit Margin Analysis. This is a key ratio. Gross margin was 73.7%.
Gross margin is the profit left over after paying for the direct costs of the service, like shopper earnings. 73.7% is incredibly high. It shows the capital-light model is working.
Operating margin was 17.7%, and net profit margin was 15.3%. Operating margin is the profit after R&D and corporate overhead. Net margin is the final, pure profit. All these margins expanded year over year, which confirms that operating leverage we talked about.
Operating margin is the profit after R&D and corporate overhead. Net margin is the final, pure profit. All these margins expanded year over year, which confirms that operating leverage we talked about.
Next is B, Analysis versus Expectations.
This is the beat. Section B.1 shows Instacart beat analyst consensus estimates on revenue, EPS, and adjusted EBITDA.
EPS, or earnings per share, is the company's total profit divided by the number of shares. The 51 cents reported beat the 50 cents consensus.
Section B.2 shows they also beat their own guidance. This is a classic under-promise, over-deliver sign from a confident management team.
Section B.4 calls this a high-quality beat. It was driven by real operational gross profit and leverage, not by lower-quality financial items like one-time asset sales or tax benefits.
Next, let's do a deep dive into the earnings call transcript analysis. This tells us the mood in the room.
The tone from the new CEO, Chris Gaz, was described in the report as overwhelmingly confident, energized, and bullish. He emphasized that Instacart is executing from a position of strength.
First, let's hit the highlights before we get into the Q&A. What were the big headlines? The pivot. Rogers made it clear they are shifting from a B2C marketplace to a technology and enablement partner. The new pillars. He explicitly pointed to the new Instacart AI solutions and international expansion as distinct growth engines. The signal. He backed all that confidence with the announcement of the 1.5 billion share repurchase.
Now let's do the deep dive on the Q&A. What were the analysts actually asking?
They were persistent on three main topics. First, the guidance. Analysts pressed management on why the Q4 guidance seemed cautious. Specifically, they zeroed in on the EBT-SNAP funding scenarios. They wanted to know if this was a deal breaker.
And the response? Management didn't hide from it. They were transparent. They acknowledged the risk, explicitly stating the guidance is partially offset by this. But they framed it as a short-term political headwind that doesn't break the long-term thesis. For investors, this transparency is actually a good thing. No surprises.
Second topic, competition. The analysts kept asking about the intense competition from Amazon, DoorDash, and Uber. Basically, aren't you going to lose market share to them?
This is where management pivoted the narrative. They refused to get into a mud fight about B2C delivery. Instead, they pointed to their B2B technology enablement strategy. They used Kroger as the prime example. They noted that Kroger, one of the biggest grocers in the world, doubled down on Instacart as their fulfillment partner for their own digital properties. The argument is, even if a retailer works with other marketplaces, they are integrating Instacart's tech deep into their own operations. That's stickiness, not just a delivery race.
And the third topic, monetization. Analysts wanted to know, okay, you have these new AI tools and international plans, but when do you actually make money from them?
And that's where the new CEO dropped the mic. He answered the valuation and monetization questions with the most powerful tool he has, the $1.5 billion buyback. It was his way of saying, we are so confident in the future cash flow from these initiatives that we are buying our own stock right now.
So, Boyd, if we had to draw a consensus conclusion from the analysts on this call, what is it? Is everyone bought in?
It's a balanced, but generally positive consensus. The analysts clearly respect the transparency on the risks. No one likes being blindsided, and management put the EBT SNAP issue right on the table. That builds trust.
And on the strategy?
The consensus seems to be that the pivot is real. The analysts are starting to value the company less on how many groceries did you deliver today, and more on how much sticky tech did you sell to Kroger. It's a shift in valuation capability. The buyback was the final piece that bridged the gap between the cautious near-term guidance and the bullish long-term story.
Next, let's do a competitive economic moat analysis.
A moat is a durable competitive advantage. The data confirms Instacart's moat is not brand. It is high switching costs for retailers. We covered this, the B2B stickiness.
But let's pause and look at the competition. How do they stack up? Let's break down the three main threats, Uber/DoorDash and Amazon.
Let's start with Uber and DoorDash. Their advantage is clear. They are massive logistics networks. They move things from A to B very well. Disadvantage: they are fundamentally logistics platforms, not retail tech partners. Their margins are structurally lower because moving physical goods is expensive and competitive. They lack the deep B2B integration, like inventory management or white label sites, that creates that stickiness we talked about.
Then there is Amazon. They are the 800-pound gorilla. Advantage: massive scale and a prime member base that is incredibly loyal. They have high margins from AWS cloud services to subsidize their retail operations. Disadvantage: they are a retailer. They compete directly against Kroger and Sprouts. Grocers are terrified of Amazon eating their lunch.
And that is what makes Instacart different. Instacart positions itself as the arms dealer, helping grocers fight Amazon. Instacart's advantage: it is a capital-light model. It holds no inventory and owns no warehouses, unlike Amazon. And because it's not a retailer, it's fully aligned with its partners. The proof. Section B.3 gives the quantitative proof. This margin comparison table is everything. Instacart operating margin, approximately 15.3%. Uber operating margin, approximately 9.2%. Amazon operating margin, approximately 10.8%. DoorDash operating margin, approximately negative 0.4%.
For investors, this table proves Instacart is not a delivery company. It is a high-margin, ad tech and platform company that has a fundamentally superior and profitable business model compared to its peers.
Now, forensic accounting and earnings quality. This is where we look deep for red flags.
The cash conversion ratio. This is my favorite truth serum metric. It's calculated by taking operating cash flow and dividing it by net income.
Instacart's cash conversion ratio, CCR, was recently reported as 1.88.
This is exceptionally high. Let's explain why investors use this. Net income is an accounting number. It includes non-cash items like stock-based compensation or depreciation. It can be massaged. Operating cash flow is the actual cash hitting the bank account. It's much harder to fake.
So, investors use this ratio as a lie detector. If a company reports huge net income but a cash conversion ratio below 1.0, it means their profit isn't generating cash. That's a red flag for earnings quality issues.
Exactly. A ratio above 1.0 is good. Instacart's ratio of nearly 2.0 is fantastic. It means for every $1 of reported paper profit, they generated $1.88 in actual cold, hard cash.
And for investors, that excess cash is what funds the buybacks we just talked about. It proves the dividend or buyback capacity is real, not just debt-fueled. Accounts receivable, AR, growth versus revenue growth. AR is money owed to the company. If it grows way faster than revenue, it's a red flag that they aren't collecting cash.
The data shows A/R did spike in Q2. Is that a problem?
No. The analysis says this was a timing issue with a large partner payment. How do we know? Because the following quarter's cash flow was huge as they collected that receivable. It's not a red flag. It's just the lumpy nature of B2B payments.
Earnings beating analyst estimates by 1 cent. Is this a red flag for earnings management?
No. The report says Instacart doesn't have a pattern of just beating. It has a history of massively beating. The recent penny beat just means analysts are finally getting more accurate.
And that's it. We've gone through the entire earnings release. Let's land the plane with the final, concluding thesis.
Q3 2025 was a pivot quarter.
Instacart is successfully transforming into the central ad tech and enterprise SaaS platform for the grocery industry. The B2B first strategy is clear, it's defensible, and all the data shows it's working.
The company is a cash flow fortress with exceptionally high-quality earnings, proven by that 1.88 cash conversion ratio.
And management is using that pristine balance sheet to signal deep conviction with a $1.5 billion buyback. The primary risk, EBTS-NAP, is real, but is being actively managed and hedged by the very diversification strategy that is at the heart of this thesis.
Wow, that was a true deep dive. That's all the time we have.
Thanks for watching Intrinsic Mover.